Ladies and gentlemen, welcome to our in-depth analysis of the U.S. housing market. In recent headlines, we've seen alarming reports about the soaring costs of home ownership, raising questions about the future of the real estate landscape. Today, we'll embark on a journey to understand the current challenges and potential solutions that could make housing more accessible. Let's start by addressing the elephant in the room, the affordability crisis in the U.S. housing market. America is currently facing one of the most unaffordable housing markets in history. The burning question is, how can we make housing more affordable? To tackle this issue, we'll explore three possible scenarios. The first scenario involves a significant increase in incomes. According to Fortune magazine, incomes would have to rise by a staggering 55% to keep pace with the surging housing prices and mortgage rates. While incomes have risen notably since the pandemic, recent months have seen income growth slowing down, making a massive income jump seem improbable. Our second option is to bolster housing inventory. However, this solution comes with its own set of challenges. Many homeowners are hesitant to sell their properties because they currently hold mortgages with interest rates below 5%. Purchasing a new home would likely mean transitioning to higher mortgage rates. This reluctance to sell has constrained the inventory of available housing on the market. However, this could possibly encourage the construction of new homes at the moment. It is hard to tell. If neither income growth nor increased housing inventory seem promising, we are left in the third option: lower mortgage rates. Unfortunately, the current stance of the Federal Reserve Bank suggests that this is unlikely to happen in the near future. The economic climate does not favor a reduction in interest rates, as the Fed's fight on inflation is still in full force. Although rates weren't increased in the last Fed's meeting, it was mentioned that there are no plans to decrease rates, and depending on how the data trends in the future, rates could rise again. So, what does this conundrum mean for potential home buyers, investors, and existing homeowners? The key lies in patience. The housing market operates in cycles, swinging between periods of advantage for buyers and sellers, with phases of equilibrium in between. Currently, the market is favoring sellers, but just barely. In our opinion, due to the heightened rates, there is less borrowing, which means less people with the means to purchase a home. Although there is a limited supply of housing on the market, there is also not as much demand for homes. That being said, there is still slightly more demand for housing than there is supply. Like we just mentioned previously, the housing market moves in cycles. This will eventually shift. While you may be eager to realize your home ownership dreams or investment ambitions, it's crucial to recognize that the housing market is ever evolving. As a financially savvy individual, you must remain vigilant about economic shifts that can influence your financial choices. In the coming months and years, three major factors deserve your attention. First, the consequences of higher interest rates, which historically coincide with economic slowdowns and potential increases in unemployment. The Federal Reserve's intention to maintain elevated interest rates for an extended period adds a layer of uncertainty to the market. Second, the resumption of student loan repayments by around 43 million Americans could place financial strain on individuals and dampen consumer spending, which is pivotal for the economy. Third, the looming debt bubble, especially the substantial amount of corporate debt coming due, poses a significant challenge. As trillions of dollars in corporate debt mature, businesses may grapple with increased financial pressure. This could lead to job cuts, price hikes, or adaptations in business strategies to navigate the shifting financial landscape. The commercial real estate sector is not exempt from the pressure, with over $8 trillion in debt due for adjustment. The abundance of vacant office spaces further complicates the situation, potentially leading to a cascading effect on the housing market. Nonetheless, predicting precise outcomes remains complex. The market's fluid nature and external variables can significantly influence the course of events. The Federal Reserve Bank may change its stance, and unforeseen factors can reshape market dynamics. As a financially literate individual, your role is not to time the market, but to comprehend the forces shaping it. Our mission at this platform is to empower you with knowledge so you can make well-informed financial decisions. We believe that by understanding these dynamics, you can make astute choices for your financial future. In conclusion, we encourage you to stay informed and exercise patience as you navigate the U.S. housing market. Challenges persist, but your financial education equips you to adapt and make prudent decisions for your financial success. If you found this video enlightening, please consider giving it a thumbs up and subscribing for more insightful content. Thank you for joining us on this journey toward financial empowerment. Together, we can master wealth and secure a brighter financial future. Cheers!